Hey everyone, Jeremy Portnoff here, back again for another market update video. For those of you who don't know me, I've been in the financial planning and investment management business since 2002. Earned several professional credential programs along the way, notably Certified Financial Planner, Certified Investment Management Analyst, and Chartered Market Technician, among others. As always, the purpose of this video is to provide you with a general update of some of the recent developments in the financial markets to give you a sense of where we're at, what's happening, and some of my thoughts. Before we begin, let's take a quick look at the disclaimer. Go ahead and pause to read. Just remember that it's really important to understand that everyone's situation is different, so you should always consult with a qualified financial advisor to assess how this information may or may not apply to your individual situation. If you'd like to discuss this with me, you can send me an email or schedule a call by clicking on the link that should be at the end of the video, and feel free to share this with anyone that you think might find it helpful. Remember, you can watch this video at faster than a 1x speed by changing the settings. All right, let's get into it. So we're looking at most of 2022 here in the chart. I want to highlight since my last video that I had done in early February, we'd had a strong January rally and it was looking pretty good because we had that low back here in October. We kind of had a rally, little retracement, went up a little bit higher, kind of retraced back to that level again, and then went higher. So we had kind of the first indication, well, maybe the down market was over. But I think since then we've clearly seen a reversal of that, and the markets kind of go back down, right back to those kind of December lows. So really, all of that January rally has pretty much been given back. And a lot of it happened really in just the last couple of days here. If I zoom in, you can see, with the exception of Wednesday, Tuesday you had a really bad down day, and then Thursday and Friday also really, really bad down days with small caps getting hit really, really hard. It's interesting because this pattern right here is a classic technical topping pattern called an evening star. Basically, you have a run up to it. You have it trades higher, ends up going lower, so you get that kind of big spike on the top there, followed through by a down day the next day. That's like a classic topping pattern. So it's really no surprise that it went down more in the days following. Now there are so many things going on here that we're going to talk about and how it relates. There's been a lot of concern over the expected inflation numbers as measured by the PCE, personal consumption expenditures. They came in hotter than expected on the last report recently, and then Fed Chair Powell testified before Congress, basically saying that target interest rates might need to be higher than previously expected, and all of this kind of helped to fuel the sell-off. And that really wasn't much of a surprise. I've been saying this for a while. If you recall from previous videos, if you watch them, even though inflation is kind of moderated, it's still kind of high. We'll go over a chart there in a little while. We'll come back to that. So, also this week, we saw the failure of Silicon Valley Bank, which is a bank that caters to many tech startups. And it resulted in regulators taking over and shutting down the bank and kind of leaving those corporate depositors uncertain of how much their funds may be recoverable. I saw some interesting things about companies like Roku, Roblox that had millions and hundreds of millions of dollars on deposit. So there's really some unknowns here. It's really the most notable bank failure since 2008, and it's raising concerns about the health of other banks and the firms that are losing money with the failed bank. And a lot of that is really driven by interest rates. They keep going up. Borrowing costs are getting more expensive. Businesses are not able to do the things they did before. It's really hurt growth investing. All the things I've said before, so I won't rehash that. But certainly, that is a lot of concern, and maybe we're starting to see the effects of those higher interest rates. Remains to be seen. But so let's take a little bit closer look here at the market charts. And so we can see that since that January 2022 high, so the market is back down about 20%, and it's up about 10-11% off the low. So it's still on the lower side. Now, when we look at some of the basic trending moving averages, the red is the 200-day moving average, the blue is a 50-day moving average. And these are looked over by lots and lots of market participants, traders alike. And so when they cross, that's usually kind of a notable occurrence. So here, when the 50-day crosses from above to below the 200-day, it's called a death cross, right? Sometimes it foretells, you know, a decline. Sometimes it doesn't. In this case, it kind of did. Although I think it's fair to say, you know, these moving averages, especially those longer ones, they are by definition slow. They are reacting. They take a while to react. So by the point that that cross happened, right, the market had already gone down quite a bit. Now it had rallied after that, and it did eventually go lower. But recently, toward the beginning of February, there you can see that it crossed back above, and it's called a golden cross. And all it's done since then has gone down, right? And so again, you know, these moving averages are kind of slow to react. Actually, these are simple moving averages. I prefer exponential moving averages, which react a little closer, quicker, I mean. But recently, it's really notable to see that the price movement has broken below both of these moving averages. That's where it becomes critical. Because a lot of the big traders, hedge funds, and big market participants, they have trades ready to go when certain thresholds hit. And so when you start getting below these kind of moving averages here, that can be a concern. Okay, let's hide those, and let's bring back. Let's talk about a couple things that we have talked about before in terms of like trend lines and whatnot. So let's take a look. There we go. So here's that main trend line I've been talking about for a while, and I had mentioned at the last market video I did that we had finally broken through this trend line. Now it had tested this trend line multiple times, which makes a breakthrough all the more substantial. However, I did say at the time where, we'll have to see if it's, because sometimes you get a breakthrough of a trend line like that, and then it just gets thrown back to the line, called a throwback. And that's exactly what we've gotten here. And I can't claim to have seen the future. It's just something that often tends to happen. Now, why is this important? Well, there's a couple of things here, because we're kind of right there, right back at that trend line again, which can be a critical point. Now, trend lines, support and resistance, they tend to flip-flop. So this trend line has been a line of resistance. The market didn't want to go above it. Now, it finally broke out above it. It has retraced back to the line. The question is, does it hold here? If it can hold that trend line, then you have a little bit of optimism that this is just a little bit of a retracement off a strong January rally, and maybe it goes up from there. If it breaks through, however, and continues lower, then, all bets are off. Now, looking at a different trend line, more shorter term, this is just setting up from the October low and where we hit these levels in December and January. And so we've got a rising trend line to watch this kind of counter trend rally as I would consider it to be. And you can see that we have broken below that trend line. You can see it broke out and kind of went up a little bit, was hanging around the trend line, and now it's broken through. So from a simple trend line perspective, this trend line has been violated, and so is it going to be support or resistance? Same kind of an issue there. Okay, let's hide those back. Looking at some of my indicators here at the bottom, this is just my simple kind of trend indicator is the shorter moving average above the longer moving average, or vice versa. So when it's red, that's kind of like things have been going down. So you can see that it has shifted to red recently, kind of bounced around a little bit. What this says is that rally is over. Where it goes from here, we don't know. That doesn't really tell us anything. The MACD, which is moving average convergence divergence, is a very similar kind of a thing there. It's kind of in that red zone there. The lines are pointing down, so that kind of indicates that the trend is going down. When we look at market breadth, this is how many of the stocks in the markets are going up versus down. We're looking at the S&P 500. So granted, that's not the stock market. It's just large cap stocks. But it's a really good indicator. The green line is the percent of stocks above their 50-day moving average. The purple is the percent of stocks above the 200-day moving average. And you can see that these have fallen off quite substantially. But they haven't gotten to any extremes yet. It just means that there are a lot of stocks that are trending below their moving averages. Now, it's really kind of interesting when you look at these lines and some potential divergence. When you look at this point here in, say, December, right, you had a kind of a short-term high in the market, and you had 89% of stocks trading above the 50-day, their 50-day moving average. Now we move over to this spot where you've got higher price in the index, but you have fewer stocks trading above their moving average. That's one of those signs where it's like, this doesn't look good, this doesn't look healthy. It's that the rally is occurring in fewer stocks, right? So when you kind of look under the surface at what's going on in the market, that's not a healthy sign. These crazy lines here are just a directional movement indicator. Basically, when this red line is moving up and when it's crossing above, then it's starting to show that the trend is getting negative. So we got this trend line. This red trend just means that there's more down days than up, and the black line is showing that the trend is deteriorating. So as we see things are going down, that upward, what was an upward trend is deteriorating. Now the red line is up and the black line has moved up. So it means the strength of the trend is increasing in the negative. So that's not a good sign. Our volume has started increasing again with that downtrend. When we've looked at those volume studies before, same kind of thing here with this cumulative line, right? We're at a point where we've got lower price. This on balance volume has been decreasing, and this has been decreasing as the trend is going up. So now, of course, the trend is going down, markets are going down, and the volume is increasing, and so it's going down even faster. So again, kind of not a good sign there on some of those internal indicators. Okay, so one of the things I'd like to look at are those Fibonacci ratios that we've talked about before. And let me go ahead and hide these guys, try to make this a little clearer. Oops. Okay, so a couple of interesting things, just a little bit of a recap here. Measuring from the lows in March of 2020, right? And this entire movement all the way up to January of 2022. And we're looking at those Fibonacci retracement levels. And you can see how when we hit those October lows right about there, let's see, there we go. That was right at 50% retracement. So it's no surprise to me that the market bounced off of that level, because all the traders, all the big players in the market, they're looking at that stuff. So that's not surprising at all. And where we're at now, we happen to be right around that kind of 38.2%, that next level. So just kind of a reminder on that I think that's interesting. But let's take it from those October lows. Okay, so we're doing another Fibonacci sequence, and I'm measuring out from the October low all the way to that end of January, early February high. And look where we are. Right at that 50% line, right at that 50% line. So again, we're looking at, not only has the market retraced back to these December levels, but we're looking to see, is that going to provide some support? Are other traders looking at these levels thinking, okay, well, it's a 50% retracement, we're back to those December lows, let's go ahead and start buying again. And that's what could fuel the next run up. And that would be a really good sense of the bottom really truly having been put in back in October. Now, there's a lot of opinions out there that October low is not going to be the low. I kind of share that opinion. Those who know me, I'm pretty bearish on all this for a lot of reasons. But at the end of the day, we want to look at what that trend is showing us. Now, if we look at the same kind of, there we go. Same kind of Fibonacci measurement, right? We're going from the January peak here to the October lows. We got here in this peak in February right about to the 50% level from that movement. The thing about these Fibonacci ratios, and it speaks to the fractal nature of the markets, is that you can see these things in different time series, different lengths of time, different movements. And so there's many different ways you can look at it. But when you look from these major movements, these Fibonacci levels can be really helpful for understanding certain targets and where you expect, and if they break through it or whether they don't, can tell you a lot about the overall trend of the market and what market participants are thinking. So same thing here. We came up, hit that 50% level, and then backed off, right? So it's really interesting. I like to look at those things. Again, it just helps to give us some targets in what we're looking at. All right, I think that's about it for those. So when we look at the VIX, which is the volatility index, you can see we've had this super, like my chart just updated, super big spike in volatility. Big spike. That's not a good sign, right? Now, going back through, I know this chart's really messy, but going back through 2022, each time the VIX got down to like under that 20 level, then it kind of spiked again. It kind of marked a temporary high in the markets. Here we've got the March, April, August, and then again, the October lows were when the VIX was at a high, so kind of opposite, right? And so we got back down here to this low in the VIX right at the market was peaking, and so it seems like again that cycle is kind of turning. So overall, the S&P 500 is very much in that kind of negative trend by my measures. We had that rally, but it's definitely moving back down. Let me bring those exponential moving averages back on that I normally look at. There we go. So we can clearly see that, in the short term, the market has been moving up, but it does appear that it has, let me rephrase that. In the medium term, the market was moving up, but in the short term, we see that it has reversed, and we've gone back below the prior high, it was December high. And so it'll be really interesting to see. Again, we're looking for maybe some support around those December lows. And if it breaks through that, then we could see some more pain ahead. Now, actually, one of the things I wanted to show before I forget here, when we're looking at the S&P from a different perspective, this is the S&P, the black line's S&P 500. The red dashed line is the price to earnings ratio at a value of 20. Which is considered overvalued. The purple at 15 is considered fair valued, and the green is considered undervalued. And there's a couple things notable here. In terms of understanding how expensive stocks are, you can see that the dashed red line has notched down a couple times. Earnings have gone down, right? But it's the ratio. It's the price has gone down, but so has the earnings, right? And so the line itself has gone down. So even though the market itself has come down, it's still at this level, still considered overvalued, right? And if in order to get down to fair value, assuming the earnings don't change, then you're looking at an S&P 500 level around 2,800, which is about a 27% decline from here, from this point, right? So in terms of a target, that would be a big concern heading down to that level, but I don't think it's unrealistic because, again, we see that stocks are still really expensive on that price to earnings ratio. Now, this is something I've shown before, kind of a similar thing, but it just tracks that price to earnings ratio over time, a really, really long term. And you can see where we are here. Now, we had approached this kind of level at about 37-ish, before things topped out. And it's come down quite a bit, but you can see it's still at a level higher than where we were in the financial crisis before the market tanked from there, right? And still we're at a level where the only other times where it was more expensive was the tech bubble when it went crazy, and then here before the crash of 1929. So we're very much in an era of PE ratios much higher than historical averages. And maybe it's going to be that way for a while, but I think it certainly suggests that the stock market is still very much overvalued, and I think that's why we should continue to be really cautious about this. So when we look at mid caps, come on, change. There we go. Mid caps, similar pattern, broke out through that trend line much higher, but again, same thing, kind of retracing right back down. Mid caps and small caps really got hammered in the last couple of days. So now the mid cap index is about 12% from its lows, which the lows were around June and October, kind of hit that level, but still about 16% from the prior highs. Small caps down about 21% from the highs and only about 10% off the lows. Again, similar pattern to mid caps, really broke out a lot more off of that trend in that particular trend line, which was kind of giving the sense of, in a market recovery, you're going to tend to see small caps leading more than, say, large caps. But I think hopes of that are very much dashed, as we can see here. If we just let's go ahead and extend this trend line to include that data. There we go. You can see that we're right back to the trend line. So again, it looks like this has been a throwback right back to that trend line. So definitely going to keep an eye on where this goes from here. With just a general negative trend there, you can see that my tabs are marked red, because what that means is that we're now below the level of the trend has clearly changed, right? What has likely been fueling that is interest rates in the bond market. They kind of hit that temporary low back here in February, and they were going up since then. And we did exceed 4% briefly, although it has backed off. And kind of going along with that big jump down, I should say, in the stock market in the last couple of days, you have yields that dropped significantly, which means bond prices have gone up. So in the last couple of days, the bond market, certainly rallied here. And you can see that here, this big gap up day for this bond index. So, but bonds are still in a bear market, right? We're only about 5% off the lows back from October, and still about 13.5% since the fall, and about almost 15% from the peak in August of 2020. So there's no recovery that's happened there yet in bonds. So yes, in the short term they're trending up, and that's nice and all, but it doesn't look good, right? Like, I wouldn't be going out running to buy bonds just yet. Anything of any like medium or long term duration, I should say. I've certainly been using the short duration and ultra short term bond funds, because they're very much cash like. You can experience some declines in those, but it's pretty minor. So all in all, that's also not looking too good with the bond market over the long term. Now, following with just some general economic stuff, we can see here this is the average 30-year mortgage rate chart, and after a little bit of a break from when we got to over 7%, got down to closer to 6%, it's moving right back up closer to 7%. And this is not at a good time, right? We're moving right into the main real estate season, and it's going to cause problems in the real estate market, basically. I mean, we're already seeing decline in price. I'll show that in a second. But the higher rates are making it harder for people to buy homes and afford homes. And then the people that are thinking about moving, maybe they don't want to move because they want to keep that mortgage rate that they've got, right? And so that's likely to create a problem in the housing market. Now, I'm tracking this Case-Shiller U.S. National Home Price Index, and granted, it hasn't gone down much from the peak. It's only about 4.4%. But what's notable is this rapid turnaround in price. I mean, when we look at the financial crisis, when housing prices peaked in 2006, you can see they started to move down, but they started to move down slowly at first before accelerating down. This is a real fast hook turn, right? So I've kind of showed that before. And in fact, I have another one here. Let me, here we go. This is a Case-Shiller for LA, for Los Angeles area. You can see that same kind of rapid turnaround, but it's down more, right? And you're going to see the same kind of thing in your bigger areas like San Francisco, New York, tri-state area, things like that. So even in desirable areas, prices can certainly go down. And I think, again, that is going to accelerate as we get further into the real estate season. I mean, it's really just the beginning at this point. So when we're looking at that yield curve, this is the difference between the 10-year treasury and the 2-year treasury, right? In a normal, healthy economic environment, you expect your longer-term yields to be higher than your short-term yields. If you are going to lend money as an investor by buying a bond, right, you expect the longer you lend your money to get a higher rate. But that is flipped on its head right now. And so the shorter term rates are higher than the longer term rates. It indicates fear in the markets. Nobody wants to lend long term. So you get this inversion. And again, as a reminder, when you see the pink is when you get that inversion. And when we look long term, once the yield curve inverts, you tend to see recession follow shortly thereafter. The gray bars are recession. So it's a pretty regular kind of occurrence. And so this thing has been inverted now for quite some time. I mean, it really markedly went into that zone here We're looking at about summer of 2022. So, it's been a good 9 months or so. This yield curve is inverting, and it's gotten deeper, right? It hit triple digits the other day, kind of backed off a little bit. But again, I mean, all eyes are on the announcement of a recession coming right around the corner here. Be on the lookout for that. Different way of looking at the yield curve is this chart here. This is a cool little tool here. So this is showing the difference between the short-term yields and the long-term yields. We look at it from that angle. But when we look over a longer period of time, which, let's see, this is about a year, right? You can see the general rise of all interest rates. So all interest rates have risen, but it's the shift in the direction in that maturities, right? So when we look down here in the lower right hand quarter, right on that left side are the shorter term yields and then your longer term yields. So if we look at something like this going back to say early 2022, you can see a normal sloping yield curve. Granted, the yields are all lower, but it's normal because you've got, if I take my mouse away, it's going to move. But you can see where it says DGS1, that's your short-term yields, and on the right, 30 are the higher. So as time went on, those yields were getting higher, but you can see that yield curve start to flatten out, right, as time went on. And then it gets markedly flatter here. And then you can see where it kind of starts to invert. So even though yields in general have been rising, the curve remains inverted, right? And it's gotten more and more and more extreme to where we are here. This is also why there's just been this kind of weird thing happening where we can get these fantastic interest rates on these super short-term CDs, like 1, 2, 3 month CDs where they're very high interest rates. So it's kind of a weird condition and I don't know how long that will last for. When we look at credit spreads, this is the difference between like the treasury bonds, treasury notes, and like higher yield bonds and corporates and high yield and whatnot. And basically what we're looking at here is when that yield curve, when that the credit spreads are rising, right, that tends to forecast a negative economic environment. So they had been rising for a while, and then it kind of coming back down here, but more recently it's been rising again. Not a lot, but it's something kind of keeping an eye on here. All right, now as far as inflation goes, let's take a look at this chart. This is the CPI, and you can see as we go over time, it's increasing, but then it really started rapidly increasing after the COVID started. This chart down here shows the rate of change. And this is important because you can see right around this level was your peak inflation in terms of the rate of change. And so you can see since last June, it's coming down. The rate of change is decelerating, but the inflation itself is still rising. This is the point that I've been trying to make, where I feel like I'm the only one in the market that realizes this, because as inflation has been moderating, the market got excited and like, oh, well, the Fed might stop raising interest rates, and then they're going to pivot and start lowering interest rates again once they push everything to the recession. And then, of course, the market rallies because of that. And it's kind of this like, I've just felt like it's a ridiculous notion. I think the market has gotten way ahead of itself, and the Fed chair even said so. He even said to the markets in a speech many weeks ago, telling the markets, like, don't get ahead of yourselves here. We're not done yet. And yet the market still kept going up. That's one of the reasons why, I've been really cautious on this, because, there's that good old saying, don't fight the Fed, right? And so even though now we're seeing inflation kind of moderate, right, that PCE, that personal consumption expenditures, you can see right here, it had ticked down, but now it ticked back up. And it went higher. So it's still at a high level. It was higher than expected. And so, the market didn't like that and kind of freaked out. So I think peak of inflation expectations has kind of hit a high. It's still lower than it was, but I think it's going to take some time to to really get back to the Fed's target. And as a result, I think they're going to keep raising interest rates. The Fed chair said that the target for rates is going to be higher. I still think they're underestimating that. I think they're going to keep raising rates for a while. Whether they're quarter or half point, that remains to be seen. But they're not done with this yet. And it's going to put increasing pressure on the overall economy and increasing pressure on the financial markets. And so I think it's really difficult to try to ignore that, basically. All right, so gas prices, came down quite a bit from their peak, and they've been just kind of bouncing around. Nothing too much to see there. Okay, unemployment, initial claims for unemployment. They had been rising. I expressed some concern about that because it's a leading indicator. Then they kind of backed off and came up again, backed off again. They're working their way back up again. It's nothing too crazy, but it's something to keep an eye on and understand. But meanwhile, the unemployment rate did tick up from about 3.4 to about 3.6. Again, it's still very low, and the labor force participation ticked up as well. Again, when you hear numbers posted in the various media outlets about the unemployment number being low, the thing you have to remember there is that you've got the labor force participation in general has been declining for quite some time. Like you go back to 2000 and you can see where labor force participation has been declining. That's basically, in my view, a demographic problem because you have increasing numbers of baby boomers that are retiring and just simply leaving the workforce. And so it leaves this kind of weird situation where it's like, oh, unemployment rate is low, it looks great. But in reality, it's just because fewer people are being counted. And so it creates a little bit of a problem in trying to analyze that data. All right, what else do we have here? We talked about debt before. I don't want to spend too much time on that. I'm going to wrap up this video here in a minute, actually. But consumer debt as a percentage of disposable income, that has been rising quite a bit. And that's something I've seen talked about as well because with the pandemic and shutdown, people weren't spending money. They kind of accumulated a lot of savings. Now people are kind of out there. A lot of people have just forgotten that there was a pandemic. They're back to normal. They're doing their thing. They're traveling, going places. They're spending money. And the consumer in general is basically running out of that excess savings. And you're seeing credit card balances rise and values like this consumer debt to percent of disposable income is rising. So it kind of it's not sustainable, right? So that's a little bit of an issue. The Fed balance sheet, we see the Fed continues to shrink in its balance sheet. That's quantitative tightening, which the markets don't like. And then I added a new chart here. There we go. Money supply. So the blue line is the money supply. And you can see it generally increases over time. And this is one of those debates about inflation. Now, obviously, we've had inflation and we can't ignore that. But when we think about the velocity of money, the rate at which the money gets out there into the economy, it's actually been declining for quite some time. But it's notable, you can see here as the pandemic hit, it just fell off a cliff. So even though the monetary supply increased tremendously, the velocity of money just went down like crazy. And it wasn't really until the last year or so you can see that velocity of money is increasing. So that is, when you have that velocity of money increasing and the money supply is very high, that's where you can get that inflation. You need kind of both conditions to exist for that to occur. So anyways, that's pretty much the update. I did start entering a couple of positions in the portfolio. I started doing that right around the beginning of end of January, beginning of February. I did not want to. So those who have listened to my last update, I said I was probably going to do that soon, and then I didn't want to. I didn't want to because I felt like the market is it's a very weak rally. But at some point, the trend is really going strongly in that direction, and you got to say, well, that's what's happening. So I started to kind of nibble back in the market, added a couple of positions, and then the market started backing off shortly thereafter, and I paused. Getting back in, and since then, with the market really deteriorating lately, I have exited 2 of those positions that I had re-entered, and I'm going to exit the other one probably very soon. So all in all, with this little bit of a rally and the correction here, losing a couple percent. I'm referring to my tactical portfolios, of course. Fully invested models, we gotta just kind of grin and bear it and ride the roller coaster on that. Hopefully we can get a couple of really good rebalancing opportunities that will help over time. But yeah, in those tactical portfolios, they're still very defensive, and I'm gonna shift right back out from those positions. Take a little bit of loss on that, but not too much. So overall, we're in a really, really great position. So that's about it for now. Again, I appreciate you spending the time to watch this. If you want to send this to somebody that you think would find it helpful, please feel free to do so. And if you have any questions, please feel free to reach out to me, get in contact, again, either by email, phone, or I'll put up a link that should work in the video. Just give me a ring. Thanks again. Take care.